Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Coca-Cola Corporation, ticker KO. This is a $275 billion company, $300 billion market cap, and operating in the beverage industry. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. So let's dive on in. We're using quickfs.net, and if you're interested in using this service, don't forget to tell them you came from Trey at DIY Investing, and you can find the link to that service in the show notes, first link on the page. So this is the Coca-Cola company. They produce beverages, market and sell them, non-alcoholic beverages worldwide. They have not only the namesake Coca-Cola soft drink, but also water, sports drinks, juice, dairy, and plant-based beverages, tea, coffee, and energy drinks. So various brands: Coca-Cola Diet Coke, Coca-Cola Zero, Fanta, Fresca, Schweppes, Sprite, Thumbs Up, Aquarius, Sealed, Dogged, Dasani, Glass Shoe, Vitamin Water, Ice Dew, Powerade, Topo Chico, Del Valle, just to name a few. Various brands here. Very powerful brands. So those powerful brands are a sign of a quality company. They have a beta of 0.557, which suggests that it's relatively low volatility. Tends to also be a sign of a high quality company, especially in the S&P 500. So now return on invested capital. First thing you can see here is they have 20 straight years of profits, which is a sign of quality. I like to see at least 19 or 20 years of profits in the last 20 years. They have 20 straight years of profits. Very positive sign for the quality of the company. Now, what you can see here is they've had a declining return on invested capital over time. I don't like to see a downward trend, but at least it's always positive, and they've kind of leveled out. Now, 2017 looks like a one-off year with some bad results, but it doesn't necessarily mean that it is as bad as it looks. That was also the year of the Tax Cuts and Jobs Act in the United States, and it distorted a lot of numbers. So I wouldn't be surprised if this number of 1% is not real. And if we look at it otherwise, you're basically holding steady in the double-digit range. 10%, 11%, 14%, 9, 9, 10, 12, 14. So over the last decade, you look really good. And you can see that here, 11% return on invested capital, 10-year median return. Very positive. That meets my threshold of at least 10%. Return on equity of 27% meets my threshold of at least 15%. So everything here on the returns is looking like a quality company. You can also see the quality because their gross profit is above 50%. In addition to the high turnover, you know it's a high turnover business because they're selling soft drinks, beverages, everything like that. So all this is really strong. Coca-Cola is clearly one of the highest quality companies in the world. However, the problem becomes valuation, okay? Valuation multiple of PE of 28 is simply way too high. Price to sales of 6.7, PE of 28 is way too high for a company with negative revenue growth. If you pay 28 times earnings for a company with declining revenue, see that they had $48 billion in revenue in 2012, $38 billion of revenue in 2021, you're going to have a problem. You're going to have poor returns. So they have declining revenue and growing assets. That is one of the things. And that is one of the things that you really need to be aware of. And when you're saying these declining return on invested capital, declining revenue with growing assets is going to lead to lower returns on invested capital. Just going to see that. That's pretty common. In addition, you see EPS growth of 2% per year, free cash flow growth of 5% per year. If you think about that, you're growing EPS at 2% a year, but you're paying 30 times earnings. So you're getting a free cash flow yield of 3.5%. So you take 3.5% plus 2%, and maybe your return is 5.5% for buying this stock. That's simply too low. Yes, it's safe, but you're getting bond-like returns for buying an equity, and that's not what you want to be getting for a company like this. In addition, you have to think about it that, yes, they've been growing their dividend, but your total return is basically your dividend plus your EPS growth. That's all you can really rely on. You're getting these 2% raises in your dividend. The earnings per share is kind of all over the place right here. It's not very predictable, but you can see that they were earning $1.97 in 2012 and only $2.25 today. They've hardly grown their EPS. It's really dreadful of a return. Basically up a little over 10% over the course of a whole decade. That's quite concerning. And you've also seen their dividends gone up about 60% in that time frame. So more and more of the earnings is being taken up by dividends over time. That's really capping their ability to grow. So despite having these high returns on equity, they're basically useless because you're not able to grow with them. And so although it's a very high quality company, there's no growth here. And And without growth, you can't capitalize on the quality. So for me, Coca-Cola is overvalued. I wouldn't even pay 15 times earnings for a company like this. I'd want to pay less than 10 times earnings for a company like this. At less than 10 times earnings, Coca-Cola would be a steal. It would be a great deal. But if you think about that, what does that mean? $22 a share? So Coca-Cola is maybe interesting at $22 a share. That's going to require over a 50% decline in its price, 60% decline in its price, 70% decline in its price before you start getting interesting. That's a concern. Now, we'll see what we can see on the next page. If you're enjoying this video so far, please hit that like button. Don't forget to subscribe. When you subscribe and ring the bell, that notifies me that then you can get notifications that I upload new videos each and every week. I'm working through every company in the S&P 500. So if you like Coca-Cola, great. If you're not liking Coca-Cola, but you might like some other companies that I cover, you need to be subscribed. Hit that subscribe button. So let's go on to the income statement. Now you can see that although they have had declining revenue, they have been able to remove cost of goods sold out of the company. They've been able to get rid of SG&A from the company. So they're managing the company very well. So you've had declining revenue, but you've had operating profit growth. That's a very positive sign for how the company is being managed. You really like to see that. In addition, you have had declining share counts over time, which is good. Now they've grown a little bit since 2017 when you bottom out at 4.2 million. But basically, they're flat in diluted share count since then. So they have been able to buy back shares and help you out that way. But it's not been a huge deal. It's not changing the overall outlook for this company. You do have some cash. Let's look at PP&E. So they've taken about a third of the PP&E out of this business. You had 15 billion. Now you're down to 9 billion. That's a good sign. They're pulling assets out while able to maintain and grow earnings. Very positive for shareholders that it's being managed that way. But you can see that they do have some buildup in goodwill, these intangibles driving those return on invested capital to what they are there. Now, you've seen a massive growth in debt. You have, what is this, 13 billion in debt to 38 billion in debt. You've grown the debt by $28 billion over the last decade, and you've hardly grown the income statement. So net income has hardly gone up, but you've had to grow your debt by $25 billion. That's a really, really bad sign. You don't want to see that in the company. See at the cash flow statement. What I want to see here is dividends. So you're paying about $5 billion a year in dividends, $7 billion a year in dividends. So how much is that? $4.5 billion, $7 billion. So 4, 5, 9, 14, 19, 25, 31, 37. Let's call it 43. Yes, you're about in the 55 million range over the last decade in dividends, but you've had to increase your debt by 25 billion. So half of your debt increase has come by the fact to help you pay your dividends, because you're paying such a high amount of dividends in addition to the cash flow being put back into the business. So Coca-Cola's performance is poor over the last decade, and I expect it to continue to be poor over the next decade based upon the trends that we see here. There's nothing that makes me leap out and want to own Coca-Cola, which is a shame because it is one of the best companies in terms of quality in the world, but without the growth, it's going to be a poor investment. If you like this video, please hit that like button. Don't forget to subscribe and ring the bell. You'll get notified when I upload new videos each and every week. I'm working through every company in the S&P 500. I'm covering all these companies. You can look at all my past companies by looking at the playlist that I have for the full S&P 500. There's already over 50 to 100 companies in that playlist. You can watch them right now. And if you enjoyed this video, if you enjoyed this study that I broke this down, consider going to QuickFS and signing up. You can sign up for free, and if you use the link in the show notes, then I can get a cut of anything that you use to sign up later for their paid service. But you can sign up for free for their free service on quickfs.net. You can click the link in the show notes, and that will let them know that I sent you to their group. So thank you for listening, and until next time, stop paying fees, start building wealth.